The bull hammer is the exact opposite of the bearish star, with O, H, and C prices concentrated towards the upper third of the candle, which indicates there is less willingness to maintain the lower prices, and instead there is more intent to move higher. Naturally, a green bull hammer is slightly more bullish than a red one, because the candle closes the session slightly higher than the opening price. The upper wick is very short or does not appear at all. In terms of broader context leading to the increased likelihood of an upswing, the bull hammer is best found in an existing downtrend near an area of established support, and the next few candles are ideally to trade above the high and eventually close above the high of the bull hammer. When this exact same candle forms during an existing uptrend, it is referred to as a hanging man candle. A sinister yet somewhat fitting name, since the outline does resemble a hanging man in some ways, and it does point to the possibility the existing uptrend can come to an end soon. Because initially, after the candle opens, the market drives down towards the low with some decent progress in opposition to the uptrend, but eventually towards the close of the candle, the market moves back up towards the open and high, and this continues the influence of the uptrend, but overall, the candle does show some intent in the market to drive down price for a possible downward reversal in the future, as the uptrend has some opposition. A firm downtrend is much more likely to develop if this hanging man candle also forms near an area of established resistance, and the following candle trades below and preferably closes below the low of the hanging man. As would be expected, a red hanging man is slightly more bearish than a green one because the candle closes below the open with a more downward bias.